Good afternoon, everybody. So today we have a really fun class for you. But I know today's class is going to be a little different, a little more unique than any other class that Quest typically teaches. Now, we did kind of give a brief overview about a lot of these things earlier on in the year, but I wanted to do a quick recap of things that are going on. So if you are attending this class for the very first time, or if you've never attended a Quest class before, I want to let you know this is not a class about real estate. This is not going to be a class about self-directed IRAs and setting up your accounts and how to use them or how to avoid taxes. That is not today's class, right? Right now, we need you guys to leverage and utilize the chat box to make sure that you can ask us any questions as we go on about all these type of things. Today, we are going to be talking about some up-and-coming potential legislative changes at the Congress level. I know these topics can be a little scary. I know they can be a little daunting. But we really want to make sure people understand what's going on at the House of Representatives, at the Senate level, and ultimately what it looks like when a bill gets passed. These bills affect all of you out there at every single level. I don't care if you make $10,000 a year, if you make $1 million a year. I don't care if you vote red or blue. I don't care about those type of things here. Today are strictly bills that are right now already on their way to being passed. Now, if you don't know what to do, if you're scared about a bill being passed, that's what we're here to talk about. So mainly, we really want to focus on today about the Secure Act 2.0. Now, what does that mean? When we talk about these type of things, really, these are things that have already passed the House of Representatives. Now, if you don't understand how bills go, we're going to go over those type of things today. So let's go ahead and just dive right on in, and ultimately, let's get started. So like I said, today is all about the Secure Act 2.0. As we go through this type of information, we always want to give you a quick disclaimer of why we're doing this. It's only for your educational purposes. Quest, we don't take any type of political side, left or right. Sometimes people think we do, but man, we can't do that. We're only here to give you guys this education. Now, why do you want to know all about the Secure Act? These are things that are going to update not just your guys' current retirement accounts at your current employer. This will affect your kids. This will affect your grandkids. Right? Believe it or not, last time we had to go through these type of things was a very scary situation. The IRS and Congress, they were trying to take things away from you guys as accredited investors. They weren't going to let you guys do certain investments. They were no longer going to let you guys do certain types of contributions. They're taking away your ability to use checkbook control style IRA accounts. Well, all that is scary. But guess what? Last year, we were able to make our voices heard thanks to everyone's help out there. And with this new Secure Act, Congress actually listened. So what's unique is normally when I have to do these type of classes, what ends up happening is ultimately it's a lot of negativity thrown in there, a lot of scary facts. But believe it or not, today it's going to be a lot about updating aspects that are really going to end up becoming a positive side of things. So once again, don't forget this is only for your educational purposes. So first off, what is the Secure Act and what does it stand for? Literally, Secure is an acronym that Congress created. It stands for Setting Every Community Up for Retirement Enhancement. What does that mean? At the Congress level, guys, they realize that by the time someone like myself, right, I'm 35 years old today, but by the time I hit 70s, 80s, most likely Social Security won't be around. Therefore, how is it that I'm going to go ahead and be taken care of in the future? That's what the Secure Act is supposed to take care of and replace. It's supposed to incentivize the next generation on why they should be saving for retirement. Now, to do so, they had to put in place certain things at every single level. Now, there in total, I want to say there's 19, it might be 20 different bills that you can see. And I want you to understand everything we talk about will be 100% cited. So you can go ahead and leverage and utilize any of the sites that we listed as a true site source. We're not going to be going through articles that someone else written by a CPA or attorney. We're strictly going off the actual bill legislative act that you can get on congress.gov. So how does a bill first off get passed? Surprisingly, a lot of people don't realize this. Bills are voted on at 3 different levels. First off, it has to pass the House of Representatives. And each individual state has certain representatives that represent your state. Now, you guys have voted for those individuals, whether you realize it or not. After a bill passes the House, and there's about 435 or 436 House of Representatives, it goes to the Senate level. Now, at the Senate level, the Senate individuals vote, and then if it passes the Senate, finally the president votes. This is what makes up Congress. Now, normally when a bill passes the House of Representatives, there's a pretty evenly split vote, right? It's almost 50-50. But usually the Democrats or the Republicans, one of them will slightly outweigh the other, and it'll be a 49-51 split or something along those lines. However, the Secure Act 2.0 passed the House of Representatives with a 94% pass rate. This is very, very rare. This almost never happens. This means that most likely it's actually going to end up passing the Senate, and we'll figure out when is it going to pass that Senate level. So when will these bills take effect, assuming the Secure Act 2.0 passes the way it's written today. So let's go ahead and dive into it. Now, as I went through these things, I found 7 key things. Once again, there's more aspects to this bill, but I found 7 key things to pull out for you guys to kind of look at, understand, and please ask your questions as I go through these things. I understand it's not the most exciting. Once again, we're not talking about setting up accounts and making millions of dollars. We're talking about things at the government level. So what are the 7 key takeaways I took away from honestly understanding and reading the Secure Act? First off, we're going to break this down by section. All right, and there's multiple different sections in there, but section 101 was about automatic enrollment. We're going to dive into what that looks like and what do we mean by automatic enrollment. Pretty much enrolling automatically into employer plans. Right? Section 106, which is really going to talk about increasing the RMD age. Now, if you don't know what RMD is, it's for a required minimum distribution. So for those of you guys out there, you're going to be getting some tax breaks by being able to delay those RMDs. Section 108, which is going to talk a lot about making catch-up contribution limits to certain employer plans, allowing you guys to make really large contributions, and you'll see that as well. Section 603, which kind of relates to the 108, right, which is all about Roth catch-up contributions. Section 109, which relates to the younger generation. This is usually going to relate to people that are 18 to about 30, right, that have student loan debt. Right? Section 601, which talks a lot about for those of you guys out there that have very small businesses, maybe you're self-employed individually, or you have maybe a small attorney practice or doctor practice, how you can set up SEP IRAs and simple IRAs, right, to make Roth contributions, which has never been a thing. Right? And lastly, section 322, which all has to deal with prohibited transactions, which you mainly only see a prohibited transaction on a self-directed IRA, something like what Quest deals in, right? And this is when you do something prohibited working with a disqualified individual inside your IRA. So we're going to dive into each one of these. Don't forget, all of this is cited directly. So if you want this presentation, just ask us down in the chat below, and we'll go ahead and get you those right away. So ultimately, great to see you can post our emails, previous quests. Yeah, I like that. Thank you. Man, you guys are awesome. I love our clients. So let's go ahead and dive into the very first section, section 101, which talks about automatic enrollment. Now, this would take place and take effect starting the very beginning of January 1st of 2022 or 2023. What it says is, moving forward, if you start a brand new job and that job offers you an employer plan, such as a 401k, a 403b, a TRS, you are automatically going to be enrolled in that plan once you've satisfied what they call the vesting period. Some jobs you satisfy the vesting period right away, like Amazon. The day you're hired, you're immediately going to be enrolled in the 401k. Other companies like a Walmart, I think you have to work there for 1 year before you're automatically going to be enrolled into their 401k plan. Now, why is that important? As of right now, you are typically not automatically enrolled. What happens is your employer gives you a whole bunch of documentation. As they give you the documentation, what ends up happening is you have to fill out how much you want to contribute to your 401k. Are you actually going to participate? Blah, blah, blah. Nope. No longer is that the case. You're automatically going to be enrolled. Now, once you're enrolled, 3% of your paycheck will be forced into your 401k. Now, you're thinking, man, so if I make $1,000 per paycheck, 3% of that being $30 goes into my 401k every single paycheck in that example. This will also increase every single year by 1% until you reach 10%. Now, I think this is unique because this means that ultimately up to 10% of your paycheck will be forced into your 401k. Now, for a lot of people, you're thinking, man, this is scary. Why is this scary? Because some of us live paycheck to paycheck, right? And if you're one of those unfortunate people that you're struggling to make your bills and you're not able to contribute to those 401k, and by your job pulling 3% out of your paycheck, don't worry, you have the option to unenroll or just change the percentage. So why is it Congress is going to go ahead and set forth a rule then to automatically make you enroll? Believe it or not, their thought process is really funny. When you read the bill, they look at this like a subscription. Your subscription to Hulu, your subscription to Netflix, or something along those lines. Surprisingly, the next generation, once they're enrolled in something, they just keep paying those fees. They keep going forth, that type of stuff. So their thought process is with this next generation, with the younger generation, that really surprisingly don't manage their money very well. If they're automatically enrolled in their 401k, they're automatically going to be saving money. And they would never bother taking the time to change it. Now, once again, if you're one of those people and you're like, man, I'm living paycheck to paycheck, don't worry, you can change it. That's not a problem. The thought process is forcing people to save for retirement account. So, man, I'm getting a lot of requests from you guys. If you notice, to just go ahead and get you guys the presentation at the very end of this, I will get that right over to you. So thanking you. If you notice on each one of these presentations as well, the link to this specific bill is right in there so you guys can cite it and read it yourself. Ultimately, I kind of like this section. I know for a lot of people out there, you may not understand your 401k or how much should you be contributing or anything like that. So by having this automatic process is really going to help the next generation save to be better off. So let's keep going. We're going to look at section 106. This is the RMD age. Now, remember what RMD stands for is retirement or required minimum distribution. Most of you out there don't have a Roth IRA. Remember, the Roth IRA is the account that grows tax-free, right? Roth IRAs don't typically have a required minimum distribution. So why do we have these RMDs? RMDs apply to any tax-deferred account, right? When I'm taking the time to defer my taxes, the IRS is great. We'll let you do as many investments as you want, and you can defer any taxes that you want to defer. But we're only going to let you to defer them to a certain age. As of right now, that age is 72. So right now, if I'm 60 years old, I can do any investments I want and defer all my taxes to the age of 72. But at 72, the IRS steps in. They say, hey, you're getting older. Right? Unfortunately, you're going to kick the bucket soon, and you need to pay your taxes. So they force you to pull this money out and start taking these required minimum distributions. Now, for the longest time, this age was set at 70 and a half, and recently it was increased to 72. But now people are getting older. And as we get older too, what's surprising is our lifespan is also increasing. It's not unrealistic to hear people living to be past the age of 90 years old. That didn't used to be a thing. This comes with advances in medicine, advances in the healthcare system, right? Understanding the ways to be better living ultimately, right? Eating healthier, knowing that coffee at noon is not the best thing for you. Love my coffee. But starting in 2023, January 1st, the RMD age will increase to 73. Then they've already have it put in place to increase multiple times over the next 10 years. So in 2030, it'll increase to 74, and in 2033, it will increase to 75. Now, some of you are like, well, why are they spacing it out like that? Most recently, when Congress increased the RMD age from 70 and a half to 72, what ended up happening, there's a lot of confusion at the CPA level, even a lot of confusion at the IRS level when you're filing your taxes. Surprisingly, a lot of people didn't know, well, if I'm going from 70 and a half to 72, but I'm 71, do I take an RMD or do I not? How is it calculated? And a lot of people didn't know. So believe it, this is one of those unique situations where Congress learned their lesson. They actually listened to people like Quest and listened to people like yourselves, right? And what they did is they said, you know what? By us increasing the RMD age but spreading it out, it will help us in tracking purposes. It helps CPAs to calculate your taxes. It helps the individual to know how old they are and where they're going to fall. So ultimately, by spacing out the RMD age and increasing it, this is going to help people defer any taxes they might owe for a longer rate. So I really do like this one. All right. Next, we have Section 108 and Section 603. Now, you're going to understand why I kind of combined these two, right? But Section 108 is going to increase catch-up contribution limits to employer plans such as 401ks, 403bs, 457, something like that, right? Now, if you don't know what a catch-up contribution means, is right now, just as an example, I can contribute $6,000 to my Roth IRA. But if I'm the age of 50 or older, I get an extra $1,000 I'm allowed to contribute, meaning I get to contribute $7,000 instead of $6,000. So the IRS says, hey, as we get older, we're going to let you contribute more money. So Section 108 says, hey, we're going to increase this catch-up contribution, but only to those employer plans like 401ks. Now, that catch-up contribution is huge. Notice in the example I just gave you, it's only $1,000 in a Roth IRA. But for this Section 108, it's going to increase your catch-up contribution by $10,000. So now I can contribute up to $10,000 more to an employer plan. However, I have to be a very specific age. I have to be 62, 63, or 64. That's kind of weird. Why would Congress say I have to be one of these specific ages? Well, when we do the math, it seems like what ends up happening is people start to realize I need to save more for retirement. And they start doing this, believe it or not, in between those ages. More than 60% of all people that are contributing a catch-up contribution to an employer plan fall within those ages. So just for that small, short little window, they're going to allow you to contribute an extra $10,000. Now, why did I include Section 603 in there? Is because what Congress is going to do is they're going to force those individuals that are making that catch-up contribution to contribute it via Roth. Roth. Why is that important? That's our tax-free bucket. That's the bucket that we get to pass on even to the next generation. No RMDs. It avoids the death tax. Wow. Congress is literally going to allow people now to start contributing way more money to the Roth if you fall into those ages. There's a hidden thing behind that, though. Really, why I like this specific aspect of this bill of 603 is last year, I probably received in between 10 to 15 emails a week, and that's not an exaggeration, on being scared that Congress is going to get rid of your Roth IRAs. Notice, though, they're literally putting together bills right now for any individual, right, to go ahead and contribute more to a Roth. I do have one of my clients on here, Miss Porter. Hi, Kelly. How you been? I haven't talked to you in a couple of weeks. I think last time I saw you was in Virginia. She's asking, does the Section 603 apply to this year? It does not. Understand, everything we're talking about today only applies, all right, if the bill passes. And we're going to talk about when the next voting section is going to be here very shortly. So understand, these haven't passed. But remember, all these bills passed the House of Reps with over a 94% approval rating. That's very rare. So It's at the Senate level. Once it passes the Senate, president signs off on it, and then these take effect in the year of 2023. So great question. Keep those type of questions coming. I love them. All right. So section 108, section 603 kind of go hand in hand, right? Notice we get to increase that catch-up contribution, and all of those contributions get to be a Roth. So I like it. I really do. I am kind of a nerd, though, right? That's why Quest pays me. They pay me to be a nerd and read this stuff, right? We got section 109. Now, this is really going to apply to a lot of the younger generation. Notice you don't have to be young to have student loan debt, right? A lot of us out there might have student loan debt. I'm fortunate. I do not. I use my GI Bill from being in the military. But a lot of you guys out there might have this. So this is where this section is really going to come into play. But if you have student loan payments that you're making, a lot of times I can't make a student loan payment and contribute to my 401k. Imagine this just for a minute. You're trying to shovel in money and save for retirement, and you're trying to make a student loan payment before you even pay your own bills, right? Before you even eat. Well, that can be very difficult, especially for a college student that just graduated, right? And is either still looking for a job or just got their brand new job. Well, the Congress realized this. So what they said is, hey, if you make a student loan payment, this can be sent to your employer as if you contributed to a 401k. Now, what's nice about this is most employers are going to match. They match a dollar for dollar. They match a certain percentage. So if your employer, let's just say, matches 1% of what you contribute. Well, now, if I made a $1,000 contribution or $1,000 student loan payment, my employer can say, pretend that I made that same contribution or same payment to my 401k, and they will be forced to add money to my account. I love this aspect because now I can pay down my debt and my employer will save for my retirement indirectly. That's a pretty unique thing. So notice some of these bills are really here to target the next generation. Remember, guys, a lot of younger people, they don't want to save. Not only do they not want to save, they don't see the benefit in saving. So these are incentives that help them save for their future. A lot of you guys out there, what you're doing is you're on here right now and you could be older than myself. All right. It's not that hard. I'm only 35. But you understand the aspect of why you need to save, why you should be doing alternative investments, why you should be putting money in your self-directed IRA today. Talk to your 18-year-old. They're going to laugh in your face. All right. A few of you guys out there are some really smart kids. But I can tell you when I was younger, I laughed at my dad. I said, I don't care about my Roth. I'm not going to live that long. Joke, 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 ha, ha, ha. But as we get older, those things change. So section 109 is a really unique thing that allows for, if you're making student loan payments, to have it count as if you made a contribution to your 401k. All right. Section 601, we're almost done, guys. I know these bills are not the most exciting, right? But it really talks about a lot of those self-employed plans that a lot of you guys might have, such as a SEP IRA or a simple IRA. Now, if you don't know what these two accounts are, a SEP IRA and a simple IRA are for small businesses or self-employed individuals that allow your business to make a contribution. Well, all the way up until recently, all of these plans were only labeled as a tax-deferred employer plan. So if I make a contribution to my SEP, which if I pay myself for my business W-2, I can contribute 25% of what I pay myself. Now, when I make this contribution, it all is labeled tax deferred as of today. So let's put some real numbers to this. If I pay myself $100,000 a year, I can contribute $25,000. That's not bad. And I appreciate that. But remember, that's tax deferred. Well, Congress said, well, instead of you putting that in the tax deferred portion, we're going to allow you to set up a SEP or simple Roth IRA. So in that same example, I can now contribute that same $25,000 and make it all Roth. Did you guys catch that? And the example I gave you, you can contribute up to $25,000 to a Roth. You can go all the way up to $61,000 in a SEP IRA. That is so unique. That is so awesome in these areas that we've never had the ability to do that. All right. Now, internally for your custodian, it might be a little difficult to track. So what are you going to do? Is you probably should get with your CPA when you do these type of tracking aspects and fill out what they call an 8606 tax form. Now, I'm not a CPA, so I can't give you tax advice, right? But overall, it is really unique that this is some things that are going on. Now, once again, if we notice, Congress is giving us a lot of incentives to save money in our Roth IRAs. They're adding Roth components. They realize that people want the tax-free growth. So many of you out there last year were scared that Congress was taking these away. I had tons of clients set up Roth IRAs in December because they were afraid that Congress was going to do away with them in January. That's not the case. So I love these type of things. And remember, guys, each one of these is cited right down below, not from an article, straight from Congress, at the congress.gov. So please, what we'll do is, like I said, we'll email this out to everyone, and it's really, really nice. PG says, you mean to say you can contribute $25K to a simple and an additional $25K to a Roth after tax? Not exactly. Great question. So when you make a contribution to an employer plan, such as a SEP or a simple, right, it's always been pre-tax or tax deferred. So now what it's going to allow you to do in a SEP IRA is say, hey, I have the choice. Do I want to make this contribution pre-taxed, right, tax deferred, or do I want to contribute all that money post-tax, aka the Roth aspect? This is really, really nice. Now, in a SEP IRA, only one person's contributing, and that's always going to be the employer. In a simple IRA, you have two people contributing, right? First person being the employee, the second person being the employer. So what this means is each of these people get to decide in a simple IRA how this contribution be made, right? If I'm the employee of a simple IRA, right, I'm an employee of a doctor's practice, this means that I might want my contribution to be labeled as a Roth. My employer might come in and say, you know what? We're also going to contribute our portion via Roth or contribute our portion via tax deferred. So indirectly, some of you guys might end up with two different simple IRAs because of how it's structured. But with a SEP IRA, it's really only one type of contribution. I hope that helps, PJ. Feel free to call me or email me if you want to dive more into that topic. I like it. All right. Steve, who pays for the 401k match for the student loan payment on Section 109? Love this. So that would be your employer, right? Not the employee. Notice what it is on the employee side, they made a payment for their student loan. Call the payment $1,000. All you got to do is send the receipt to your employer, and they treat that as if you contributed $1,000 to the 401k. And then they'll match that portion of whatever their vesting plan says. Sometimes it's 1%, or 3%. Sometimes it's dollar for dollar. Every company is going to be a little different in that area. So I hope that helps, Steve. Great question. Keep the questions coming, guys. If the employer gets reimbursed by the feds, that is a public tax dollar used to pay someone else student loan. Well, so usually what happens is with your employer, and guys, we're talking real quick and click back on this on Section 109 is what Steve's talking about. Just don't want to confuse people. But when an employer makes a contribution to an employee's 401k plan, the employer gets a tax deduction. If you think your employer dislikes you and that's why they contribute to your 401k, you're wrong. Most of the time they're doing this because they get a tax deduction. So they're not being reimbursed by the feds necessarily. They're getting a tax deduction at the end. All right. Russell Thomas. Oh, man, Russell's one of our biggest clients. Miss you out there in Arkansas, big guy. Is Congress answering to Social Security unable to meet their commitments in the 13 years? It's a great question. And I have to steer around this very carefully because remember, Quest can never provide investment advice and we don't want to take sides, right? Red side, blue side. But when we're talking about these type of things, guys, bam. When we're talking about these type of things and unable to meet Social Security, it seems like they're really, really implementing a lot of advantages for you to save for retirement because there may not be Social Security by the time we get older. So great questions. Any changes to UBIT or UDFI taxes? Nothing that's in a negative way. All right. So great question, but it actually doesn't have to do with the Secure Act. So this whole presentation is about the Secure Act, but when we talk about unrelated business taxable income or unrelated debt finance income, there has been no immediate changes that we can see in the near future. Steve says, my question was not answered. Well, Steve, I'm not sure how I can answer your question then. Let's see. Hold on, because I like these type of challenges. He said, if my employer gets reimbursed by the feds, that is a public tax dollar used to pay someone else as a student loan. Not sure really how you want me to answer that, Steve. Because understand that, hold on. Did you just say? Who pays the 401k match for the student loan payment in Section 109? Remember, I said that was your employer. So, and when we talk about this one, remember, the company made a contribution to a 401k, so they took a tax deduction. I'm sorry if the feds want to use your tax deduction that you're taking, but I guess I don't understand what you're asking, Steve. I do apologize. So, tax deduction, he says. Thank you. Okay. Bam. On a prior slide, did you say you can catch up Roth contribution 62 through 64? Or do you still wait 5 years and doing the Roth contribution before you can withdraw both principal and gains? Bam. So she's talking about right here, Section 108 and Section 603. Great question. So on here, really what it means is once you start contributing to a Roth, you start a 5-year clock. Now, what this means is you have to have a Roth IRA or a Roth employer plan for 5 tax years before you can take a true tax-free distribution. So if you are just now starting at age 62, yes, you're absolutely right. You do still have to wait 5 additional tax years. However, if you happen to start a Roth earlier, as an example, I'm 35. If I start a Roth today, by the time I hit my 62, I've already started my 5-year clock. I also always describe the 5-year clock as a clock that has been put in place by the IRS, not your banking institution or your custodian. This means once you've satisfied it, you don't need to re-satisfy it. It's already satisfied. So I hope that helps. Great question. How would the entire catch-up be forced into a Roth or just additional 10K? So if you're going to make on Section 108 and 603, if you're going to make this additional catch-up contribution to your employer plan, the Congress is going to force that contribution to only be labeled as after tax. Now, some of you guys out there may not have a Roth 401k or a Roth component. What it's going to do is force your employers to actually set that aspect up. So I know you're asked, like, how is that going to happen? It's just going to happen. That contribution you made will not be taken pre your paycheck being paid to you. It will be taken post your paycheck being paid to you. So it's always going to be an after-tax contribution moving forward if you're in one of those ages. And remember, that is only for the additional $10,000 catch-up contribution. So, bam. Keep the questions coming, guys. I like this type of stuff. So notice 601 is where we ended off. That was a step and simple Roth contributions being added. The final section is sections 322. Now remember, there's a lot more sections on there. There really is. But these were the 7 sections that I really thought would apply to most people that are attending this webinar. And that has to do with prohibited transactions, all right, and a self-directed IRA. As of today, if you enter into some form of prohibited transaction, it does, quote unquote, blow up your entire self-directed IRA. I always like to use the term, you lose it all, right? So if I own 3 rental properties in my IRA and I do a prohibited transaction in 1 rental property, well, I lose all 3 of those. Boop, they're all 3 distributed to me at face value. They backdated, they tax you a whole bunch of penalties. Oh, it's a big pain in the butt. However, starting in the year 2023, if you do a prohibited transaction, no longer will it actually blow up the entire IRA. It will only affect that one investment. Now, I think this is really unique because this is going to affect a lot of people with what I call the checkbook control style IRAs, where my IRA owns a trust or my IRA owns an LLC. The LLC or trust then goes out and does an investment. All right. These type of things are typically, well, the IRS will label as one investment. So it'll still blow up the whole IRA. Right? Just because you use that LLC to buy multiple properties, they don't consider each property a different investment. They actually just consider the LLC an investment or the trust. But what's nice to know is in these type of aspects and in these type of movements, Congress is literally writing code to benefit your self-directed IRA. Now, there will be some, if you do still enter into some sort of prohibited transaction, you're going to have a new type of tax you've probably never been aware of, something called net income attributable tax. And really what this does is when they backdate the transaction, any gains that you earn from that investment are going to have to be backdated as well. And you're going to have to calculate what those would be each individual year. But ultimately, I kind of like this. Once again, this is going to hurt a lot of checkbook control people. However, all you need to do is maybe set up multiple IRAs for asset level of protection, because no longer would it affect every single IRA. It's going to affect one. So this is why I kind of like this aspect. And it is something that we're going to be seeing and tracking moving forward consistently. So, oh, look at that. Getting some thank yous up here too. I appreciate it. So let's see. For clarification on the Roth 5-year again, please. If you started a Roth account in 2000 and you turned 62 in 2024, plus contribution, do you wait 5 years? No, you do not. Notice you've satisfied your Roth in your example you gave. Your 5-year clock was satisfied in the year of 2005. This means that you've already satisfied. It doesn't start over, right? You have satisfied your 5-year clock. If you really want to understand more about why you satisfied it, you want to go to IRS publication 590-B, go to page 35. That's how often I do this, right? But on the right-hand side, you should go ahead and see right in there why, but the 5-year clock does not start over. Once you satisfied it, you're satisfied. So great question. Once again, that was IRS publication 590-B, page 35. Might be page 34. All right, guys. So why did Quest want to teach this class? We think it's very important for all you guys to get out there and understand these type of things. We really do. I love the questions I've been getting. This is actually one of those classes that I've seen more questions come into play. And I think it's because we're not talking about just self-directed IRAs or just real estate, right? This is something that is going to affect everyone at every individual level. So we want to make sure you guys are educated in this area. And I promise you, we'll go ahead and get you the email of this type of things. So in conclusion of some of this stuff, it seems very much likely this bill will pass in the month of June, which we haven't seen it, or maybe early July. Congress is really becoming aware of your self-directed IRAs, and they're becoming very, very pro-Roth IRA. If you do have questions about these type of things, man, that's why you want to reach out to us. You don't need to be one of our clients for us to answer your questions. You don't need to be one of our clients to watch this free webinar. We're here to help you guys out. And that's why you want to reach out to anyone here on the sales team, okay? But I really want to make sure that you guys understand why the other reason is that we want to host these classes. Most of you out there surprisingly don't vote. You know how many times I hear that people are upset at Congress, or they're upset at a certain bill that's passing, or they're upset that something's going on? But then ask that same person if they voted. No, they didn't vote. Now, did you guys know the next election for your local government that's in your area is in November? So in Texas, which is where I live, it will be November 8th, where we get to vote on our new people that will be representing us. So make sure you register to vote. I added the link down here for everyone so that way they can register the vote themselves to make it easy on you guys, right? Know who is representing you. Once again, I don't care if you're voting red or if you're voting blue. That doesn't matter, right? Just know who's representing you, what you want out there most. That's it, guys. If you want to make a difference in today's world, if you want to make a difference in your community, right? Sometimes it's not just doing what's right. It's trying to make your voice heard. I promise you your vote counts. I know a lot of you guys don't think it does, but the more we can make our votes count, the more we can make our voices heard, the better things will become for you as an individual. So if you're out there and you do register to vote, if you have voted, all right, or you're going to end up voting, let me know. And I can't ask for your voter registration card. So unfortunately, I kind of have to take you at your word. But if you're out there and you're like, you know what, Derek, I am going to take the time. I am going to register to vote. I am going to take the time and I'm going to make sure that I vote in this next up and coming election, right? I will personally waive your IRA, your IRA application fee, 100%. Now, I can only make this available for 48 hours, guys, just because this isn't something that's super special, right? But if you are going to take advantage of this, I need to know that you either register to vote or you're going to vote, all right? Or let me know you voted in the past. Don't tell me who you voted for. You don't need to send me your registration card. Please, nothing like that, all right? So, and I do see some people out there, my moderator sending you guys some links that you guys can go ahead and see to just go ahead and set up an IRA. But once again, don't do this until you've either registered to vote or you're going to vote. All right. So I do hope you guys enjoy this class. I see a couple other questions popping up. Clint, also certain kinds of real estate transactions were going to be prohibited that are currently okay. Did that change? Great question, Clint. So on this type of aspect, what he's asking is certain real estate investments being, if you were labeled as an accredited investor, you no longer could use your IRA to invest into accredited investments, such as multifamily, senior living facilities, storage units, almost any type of syndication. Clint, we got all of this thrown out the window. It's actually really simple. You know why? Because that bill was absolutely ridiculous. Now, that was last year. He's talking about Bill 138, 314, if you want to really look into it. As of right now, we've gotten that removed. So don't worry, that's been taken away. Great question, Clint. I love this. Alyssa, great information. Oh, thank you, Alyssa. I appreciate it. My wife's name's Alyssa, so I like that name. Is there any changes to the backdoor Roth contribution? Daphne, no, there's not. If anything, they're becoming more and more pro Roth contributions. So if you guys don't know what a backdoor Roth contribution means, is everyone out there qualifies to make a Roth contribution today. I don't care if you make $1 million a year. If your CPA says you don't qualify, you need to find a better CPA because that means they're lazy, right? So yes, nothing has changed in that aspect. You can still make a backdoor Roth contribution. At some point, they were going to max limits and value retirement accounts, 10 million, I believe, still in the bill. Nope, Clint, that has been removed as well. That bill that he's talking about right there was Bill 138, 312, which is where pretty much if you had more than $10 million in a retirement account, they're going to make you start doing distributions, all this other stuff. Guys, you got to remember, those people that are at that Congress level, they're probably building wealth in very similar ways you are. They're not going to do anything to damage that. So sometimes what ends up happening, these bills get thrown in there, and they just don't know it. So all we have to do is make our voices heard, and you do this by voting, guys. So if you have any questions, I want everyone out there right now to quickly either send me an email, right? So that way we can email you the presentation. I'll email you the slides. Or if you want to take advantage of setting up a self-directed IRA today, all you got to do is register to vote in your local state, in your local community, and I'll take care of you. I promise. So guys, I really hope you enjoyed this class. It is something that's different. It's something that's unique. You know, we don't get to do these things very often. So overall, I hope this helped, and I'll talk to you guys soon. So bye, everybody.